and I want to present a workflow. Here's the equity curve that we get doing this particular backtesting. I like the fact that it's a smooth, somewhat smooth, upward sloping. I look for stocks that are above $5. Here in this line, I'm saying that constrained accounts, if the account is less than 25,000, you can still deploy this particular strategy. So here's the SQX code.
Today, I'm joined by my friend Christos, a true trading veteran with decades of experience. This session is pre-recorded. However, we are here to answer your questions if you have any. Christos will share 3 trading strategies for AlgoCloud, all built on proven knowledge that's been around for years. The message is simple. You don't need to reinvent the wheel to build reliable trading robots. We are looking forward to your questions and feedback in the comments. We'll collect them and return to them together with Christos in a future video. And just one quick note, everything you will see is for educational purposes only, not for financial advice. Christos, over to you. So, hello, Christos. Again, nice to see you.
Hello, Cornell. Nice to see you again. Hello, everyone. Today, I'm excited to present 3 particular strategies that have developed almost a year ago, and I've actually deployed them into Alpaca Live accounts. And I want to present a workflow that took place, from the original idea inception through the modeling using the SQX language, through the backtesting, and finally through the deployment. Before I get to discussing the particulars for these 3 strategies, I want to talk a little bit about my background as a trader. I started my trading career in the late 80s, and initially I focused on futures trading, but slowly I got interested in stocks trading. And even though the road to futures trading was a little bit challenging, when it came to stocks, it was struggling. I was struggling. The struggle was due to the fact that I was a discretionary trader. And as a discretionary trader, I was trying to combine fundamental analysis with technical analysis. And it was challenging just to find the right mix. It was very time consuming, and it had a lot of ups and downs. I used to do sector analysis. I was looking at fundamental analysis, listening to earnings calls, reading news releases, and of course, doing some technicals such as breakouts with high relative volume. So as a result of all this, the performance was inconsistent when it came to stock trading. So I have been looking for years to automate this stock trading effort, because I realized that that was the only way for me to proceed. In early 2024, I came across the StrategyQuant X tools, and I immediately realized that that's the solution that I was looking for. It was allowing me to quickly implement an idea, do extensive backtesting. I had the database right there. I had the stress testing part right there. And lastly, the onboarding of the strategies onto a live account was a very easy process. Now, I have a total of 35 strategies deployed across 4 live Alpaca accounts. And these strategies are a mixture uh, in terms of how they approach stock trading. Quite a few are mean reversion. Some of them are trend following. Some of them break out, and a few of them seasonal and pairs trading strategies. The stock universe that I have these strategies deployed on are the S&P 500, Nasdaq 100, and Russell 3000. Uh, it's important to point out that about 22 are single asset strategies. In other words, they deal with a single stock symbol and try to capitalize on the availability of leveraged stock ETFs, such as Apple has a leveraged ETF and Nvidia and so forth. I have these single asset strategies deployed as well. Now it comes to the part where I get the inspiration for the strategy ideas. Apart from my own strategies, I'm very much interested in searching various books and various forums for ideas. The books have a distinct advantage, especially the old ones, that the ideas are out in the open for many, many years. And when you do a backtest today, a lot of the data is out of sample. So you can see immediately if the idea stood the test of time or not. The particular books that I found helpful are the Trading Systems and Methods by Kaufman. This is like an encyclopedia of a lot of good systems. Also, the Encyclopedia of Trading Systems by Kaj. Trade Systems That Work by Streitzman. The Master Swing Trader by Farley. Particularly useful is the book by John Carter named Mastering the Trade. And of course, the all-time classic, The Long-Term Secrets to Short-Term Trading. Also, some additional books that I found helpful is the Old Handbook by Gil Morales, Trade Like a Hedge Fund by Altucher, How to Make Money in Stocks by O'Neill, which is also a classic, and Entry and Exit Confession of a Champion Trader by Kevin Davey, which is very rich in providing particular entry and exit methods. I'm also looking at various accounts on Twitter, presently X, and one particular account I found very useful is by Jeff Sun. This is the call name of Jeff Sun. And of course, there are a lot of other algo traders on Twitter. And lastly, on YouTube, I follow the Stat Oasis channel by Ali Casey, who has done a wonderful job in presenting various ideas and also how he implements those ideas on SQX. And also Kevin Davis' Algo Trading channel, which also has some good ideas. Let's start with the first idea that I implemented. It's called Buying the Gap Down. We all know that when people wake up and they see their stock gapping down, they get very emotional. And quite a few investors can't wait to get out of the stock, seeing the losses piling up. So this particular idea the author is presenting is trying to take advantage of this emotional decision that stock traders make when they see their stock gapping down. So it's worth mentioning that this book was published back in October 3 in 2004. So basically, it's been in existence for 21 years. So all the backtesting will do with data up to 2025 for these years is basically not a sample test. So here's the basic idea. You buy a stock when the day before was down, and today the stock is opening with a 5%, at least a 5% gap relative to the close the day before. But in addition to that, the QQQ is also gapping down at least a half percent. And the method for exiting this particular trade is to liquidate the position if the gap is filled, or at the end of the day, whichever comes first. I decided to modify this particular strategy after some testing, and also because of the great power of SQX to test a bigger universe of stocks. Because originally this idea was had in mind the Nasdaq 100 universe. So instead of using the QQQ as the market index, I use SPY, the SPY ETF. And of course, I'm looking at the Russell 3000 universe. And the last modification is that the strategy gets out of the position on the next day's open. So there's no target profit and not closing end of day. And this particular exit method is friendly for PDT constrained accounts. If the account is less than 25,000, you can still deploy this particular strategy. So here's the SQX code. So basically, yesterday's close was below the days before of yesterday's close. The open today is less than 5% of the close of yesterday. And here, this statement has a subchart 1, and in subchart 1, I have the SPY ETF. So we're saying here that if the open is less than 0.5% of the close of yesterday of the SPY ETF, then it's a valid condition. I have a setting here that the close is greater than $1 because we don't want to deal with very low price stocks. And lastly, we want the volume yesterday to be less than 2 million because we want to focus on the small cap and mid cap, because I found this particular strategy is very effective on low caps and mid caps, and potentially because the institutional involvement is less. You get a lot of small investors who get very emotional when their stock gaps down 5%. And we exit after one bar. So we're not liquidating the position the same day that we're taking the position. This slide explains everything I just described. Here's where I define the subchart 1 to be the SPY, daily SPY closing. This is a setting you need to make on the SQX. And now we come to the position score, where first of all, the strategy can open a maximum number of positions, 5 stocks at the same time. And the ranking function ranks higher stocks that open down the most. So this expression gets maximized as the open is lower relative to yesterday's close. So this slide explains the previous slide. The money management function I have is $100,000 with no reinvestment. So for the duration of the backtesting, we have a fixed capital of 100,000, which we're not reinvesting. And the period that we're backtesting is from beginning of 2000 to about the end of 2024. And of course, the Russell 3000 universe. And this slide here shows the condition. Basically, we enter on bar open and we're exiting on bar open. Now, I need to make a comment here that when you the strategy on Algo, it will execute at 9:32 a.m. That means that in some instances, the open have happened, let's say right after 9:30, so you're missing the first 2 minutes. Now, in practice, over a year, after deploying this strategy for a year, it doesn't make all that much difference, but you need to be aware of this. And later on, I'll explain how you can sort of remedy this particular discrepancy in the time that the strategy takes position. Just a comment that in my data bank, there are over 12,000 symbols for the Russell 3000. So quite a few symbols have been delisted. So the backtesting includes a lot of delisted stocks. So we don't have survival bias in our backtesting. Here's the equity curve that we get doing this particular backtesting. I like the fact that it's a smooth, somewhat smooth, upward sloping equity curve. In the x-axis, we have the number of trades that have been done over this particular time interval. It shows few bumps, and you'll see that occur in certain years. Listing the same strategy with the x-axis as being the time, it shows that for some particular stretch of time, the performance wasn't all that great, even though it was positive. Drawdown is a very respectable 12%, and that's the open percent drawdown. And the yellow curve down here is the SPY buy and hold performance on a risk basis. Also worth noting is that the exposure time is very small. My screen at the moment is small. I can't see very well, but I think the exposure time is the order of 12 to 15%, which means the capital is available to be deployed elsewhere. Now, going to the particulars of the performance of the strategy, is we see that it's got a 64% average return with compounded annual growth of 12%, and a return to drawdown ratio in excess of 46, and 62% of the trades are profitable. It's a very, very nice strategy. I believe this type of strategy of buying the gap down should be strategy portfolio. As you can see here, listing the years, the months in a row and the years in a vertical manner, this particular strategy didn't have a single down year from 2000 to 2025, which is very remarkable given some of the bear markets we had experienced, like the bear market 2008 or the COVID 2020. Also, it's worth noting that this particular strategy had 2 months in a row as negative months, but the rest of the months were positive, which means that if we see 2 negative months, we shouldn't get disappointed. It's part of how this particular strategy behaves. Now I want to show a particular example of a successful trade for this strategy. Of course, 60% are profitable and 40% are unprofitable. This particular one was picked because it shows what a perfect trade is for this particular strategy. So we'll go back in April 6th and we'll look at the SPY. And the SPY had a closing of 505.26.26. And on April 7th, it opened with a gap, certainly a gap of 0.5%. At the same time, this particular stock, Rimini, symbol RM and I, had closed this particular day here lower than the day before. And on April 7th, the same day that the SPY was gapping down, it got more than 5%. And this one was entered at the open at $2.7 per share. The strategy liquidated the position at the next day's open, which was at $3.35. So if you deploy this particular strategy, what you can do is create some offshoots of the strategy where they not necessarily buy at market, but you can put limits so you can guarantee that you can buy it at a favorable price. So apart from market order at 932, you can also have offshoots of this particular strategy that may open, let's say, at open minus a very small percentage of ATR. Okay, let's go now to the second strategy. This was inspired by a posting by Jeff Sun. Jeff Sun has a good presence on Twitter with many good ideas. He's a money manager. He has written a lot of filters for trading, and is one of the accounts that I'm actually following. So one particular idea I liked was to go long authorizing exponential moving average, 20-day exponential moving average. So basically what we want to do is locate stocks that have an upward sloping exponential moving average for 20 days. But over the recent few days, they're experiencing a constrained range. And we're on the lookout for the stock to close above this particular tight range. So what I've done is on the Russell 3000 universe, I look at the 5-day range. And when I'm talking about range, I mean the highest high and the lowest low not being more than 3% over this 5-day span. We want the close yesterday to be above this range. And at the same time, we want the 20-day EMA to be climbing. To be above the 50-day EMA. So basically, I implemented this particular way. I look for stocks that are above $5. Here in this line, I'm saying that the day before yesterday, the maximum range for 5 days was less or equal to 3%. We want the close yesterday to be above the highest high of the previous 5 days. We want the EMA 20 yesterday to be above the EMA 20 of day before yesterday. So basically we have an ascending EMA. And lastly, we want the 20-day EMA to be above the 50-day EMA. These conditions are. And how do we exit? We exit either the rate of 10 days becomes negative, or if that doesn't happen, we exit anyway after 10 days. So in this slide, I'm explaining again what all the lines mean. Now let's get to the ranking function and the maximum number of positions, the testing interval, and money management. We basically want to buy at the open, and we want to exit as well. Now, we take a maximum number of positions to be equal to 10, and our ranking function gets larger the closer yesterday's close is to the EMA. So basically, we want to be as close to the rising EMA as possible on a closing basis. So if multiple stocks satisfy the previous conditions, we select the ones that are the closest to the EMA 20. The interval, the testing interval, is from end of 99 to mid 2025, August 2025. Again, the money management is that we have $100,000 capital, which we deploy equally among these positions, and we do not reinvest the capital. So it's like a fixed capital throughout the testing period. This is the equity curve we get. It's fairly smooth. Again, the x-axis is the number of trades that this strategy takes. So we see that it takes quite a few trades through the 25-year period. If we set our x-axis to be in the time domain, what's remarkable is that in years such as 2008, when we had a severe bear market, and also in 2020, when we had also a severe decline, that we still had a positive slope in our equity curve. And that's because of the condition that the 20 EMA is rising, which certainly doesn't happen in a bear market, that the 20 EMA is above the 50 EMA, which also is a condition that doesn't occur often in a bear market. But more importantly, the tight range, the 5-day tight range less than 3%, it doesn't happen because of severe declines in the stock. So that condition doesn't hold either. So effectively, this strategy is shutting down when the conditions are not favorable. Now, the yellow curve here is also the buy and hold SPY ETF. So on a risk-adjusted basis, we see that this particular strategy is far outperforming the buy and hold for the SPY ETF. This is the monthly performance. We see from end of 99 to August of 2025. There have been 2 years so far. It remains to be seen what will happen with 2025. And in addition, we see that this particular strategy may have like 1, 2, 3, 4 months in a row that are negative. So if you deploy this strategy, don't get discouraged if you see like 3 negative months back to back. This is the table, shows the particulars of the performance of the strategy. It's about 14% annual return. The percent drawdown on an open basis is about 9%. Profit factor is 1.49, and the return to drawdown ratio is a little bit over 22. And about half the trades are losses and half the trades are gainers. And also the compounded annual growth rate is 6.25%. Also, I like the fact that the stagnation period is fairly small. Here's another table that shows the performance of the strategy. Basically, it concurs with the previous slide. It's mostly profitable, with 2 years being negative years. Now, this is an example of the strategy working as it should. We basically have, on this particular day, a rising EMA 20, which is this cyan color, which is also above the blue EMA 20. We see that the previous 5 days range conforms to our criterion. And we see that in this particular day, we closed above this tight range. So we enter the next day at the open, which is 11th of July. And basically, we're holding till either the rate of change of 10-day rate of change becomes negative or 10 days go by. And obviously, in this particular instance, the rate of change for 10 days never went negative, so we exiting here on the 25th of July. Let's see. Also, this is another example how when the strategy works perfectly. Again, we have a upward sloping EMA 20. We have a tight range. On this particular day, we have a closing outside this range. We go long at the open of the next day. And basically, we exit either when the rate of change for 10 days becomes negative or 10 days go by. And in this particular instance as well, the rate of change never went negative, and we're exiting after 10 days. So basically, these two examples showing when the strategy works perfectly. These are winning trades. Okay, let's discuss now the third and final strategy. Larry Williams published a classic titled Long-Term Secrets to Short-Term Trading, and it was published back in 1998. And one of his mean reversion strategies was the 7-bar rule. And this particular strategy that he's commenting about, of course, he used it on trading for futures. So I decided to test the idea to see how well it will perform when it comes to stocks. So the basic idea is that if today's closing is the lowest of the last 7 trading days, you buy, and if today's closing price is the highest of the last 7 trading days, you sell. It's a very, very simple strategy and impossible to curve fit. Again, I decided to utilize the power of the SQX and test it on the Russell 3000 universe. So it's also worth noting that the strategy is 27 years out in the open. So all our backtesting data is out of sample. So here's how I implemented the SQX code. Just 2 lines. Basically, we want today's close to be the lowest of the last 7 days. So including today, today is the 7th day. We want to be the lowest closing. But I put a filter here. We want a linear regression angle of 100 days for the stock to be positive. So basically, we want stocks that are in an uptrend for the last 100 days. And we exit either when today, the closing today, is the 7th highest, or if this condition is never met, we exit after 20 bars. And here's I'm commenting on the previous slide. Again, we buy on the bar close, and we also exit on the bar close. The maximum number of positions we take are 10. And for ranking function, I decided to select stocks which are satisfying the previous conditions, but also the strategy prefers stocks that are experiencing a low standard deviation or low volatility. So the lower the volatility here, the higher the value of this expression. And I did that on purpose because when you're buying the low of the last 7 days, the stock could be actually in a free fall. And we don't want to be catching knives. So essentially, we want to focus on stocks that experience a mild decline with a 7-day closing low and not attempt to get into a stock experiencing high volatility. In the testing of 1999 to August of 2025. The fixed again is $100,000 that is equally on all the positions, and there is no reinvestment. The curve is smooth. There are certain years because of the severe declines that we have some downward bumps. We observe that in general, this is an upward sloping equity curve. The performance of this particular strategy is 13% annual rate with 6% compounded, 1.44 as and the return to drawdown ratio is a little bit of 13, and it has a fairly high winning rate. I want to see something in the previous slide. I did not put the buy and hold for SPY, but also it's outperforming basis the SPY buy and hold strategy. This is the table of the monthly performance. Basically, it's remarkable that it had only one negative year in this particular stretch, but you may get something like 3 months of negative performance, like in this particular year or this particular year, and so forth. So, getting 3 consecutive negative months is to be expected. Particular. Now let's look at some examples. This one has to do with ACLX, a stock here, where the 7th-day closing was the lowest. If you include this bar plus 1, 2, 3, 4, 5, 6 was the closest low, and at the same time, the linear regression slope, which is on the lower pane here, is positive, is above zero. So that means on a 100-day basis, this particular stock is on an uptrend. The position got liquidated 2 days later because the stock closed at a 7th-day high. So this particular strategy, you could be selling actually the next day. The next 7-day high could happen anytime after you take the position. This is another example. Just like an example before, we're seeing that this particular stretch has low volatility, and that's what we want. Also, in this particular example, we're experiencing low volatility, and that's exactly what we want. This particular day, we're closing at the 7th-day closing low, so we buy at the closing, and we still have a positive 100-day linear regression, and we sell 3 days later at the close because the stock has reached a 7-day closing high. So these are my closing remarks. Basically, we're living in a great era where we have access to the internet and a lot of sources for ideas. And it turns out there are a lot of ideas, even if they're old, they're still profitable. In order to avoid the danger of curve fitting, you can use these old sources and test them on recent data, because effectively they'll be out of sample. And I like a lot the SQX platform, the AlgoCloud, because you can very quickly, as I showed, you can very quickly implement the ideas and do the backtesting. But I think the holy grail is to find many different ideas that are active during different phases of the market and combine them, because that way you will get a smooth equity curve and will diminish the drawdowns. Thanks for attending this presentation. Back to you, Cornel.
Thank you. Thank you, Christos, for sharing those strategies. And if anyone will have any question, just let us know in comment, or you can ask even via email. and we are ready to answer, or even we promise to record some video with the answers.
Right, we can record another video with all the answers or any comments, any suggestions how to improve the strategies.
Yeah, so thank you again, Christos, and see you next time.
You're very welcome. Very welcome. It was a pleasure.
And that's all for today. If you enjoyed this video, don't forget to hit the like button and subscribe to the channel for more sessions like this. You can also start testing all 3 strategies right now by clicking the link below. Just create a free trading account at AlgoCloud and open the strategies directly. If you have any questions or feedback, drop them in the comments. We'll discuss them in detail in one of upcoming videos. We are looking forward to seeing you in the next session.